Welcome in, investors. Today I'm going to do something a little bit different, considering that we're kicking off the new year in a few weeks here. It is ridiculous how fast this year went by and how this market really responded to everything in its face. We came into 2023 thinking, well, recession is definitely a possibility, but it never really came to fruition. Most people expected a recession, and those most people are wrong. Now most people are expecting 2024 to be a new bull market. And I'm always very level-headed when I take positions and when I look at the overall macroeconomics here. So let's talk about the bull and the bear case. Now the bull case is we have seasonality. There's $6 trillion coming into this market now. We're going into an election year. The market's rallied substantially off of the recent lows. And with this recent rally, you normally get double-digit rate of return in the following year. Labor markets are ridiculously strong. Consumer spending is actually holding in there very well. But specifically, consumer spending's holding in well with services, not necessarily goods. As we saw by Nike's earnings, this is a clear tale that the consumer is really focused on life experiences and still living life to the fullest. Yields are coming down, which is signaling bullish action into the market because now there's less competition for stocks. Cost of capital is coming down, which means that should expand margins longer term. And there's been a tremendous amount of stimulus being put in this economy with the IRA Act, the CHIPS Act, and the Federal Reserve jumping in to bail out banks. They also pushed off student loans for such an extended period of time that kept extra money in the consumer's pocket. So we can definitely see a pretty solid bull case heading into 2024. But before we get to the bear case, let's talk about where markets are after this recent rally. So a few things I want to talk through when we're talking about the S&P 500 PE ratio. Now currently it's sitting right around 23 to 24 times earnings, and that is historically high. And over the last 10 years, you've been looking at basically an 18 to 19 PE ratio in a healthy environment. And so we're definitely a little elevated here, probably trading 25% above where we should be trading. But the forward PE is kind of where we need to stay focused. What are forward earnings going to be? And researchers are going anywhere from $210 a share all the way up to $240 a share. And so if we just put a 20 multiple on $230 a share or $235 a share, it gets us an S&P 500 right around 4,700. And that's about where we're trading today, which means there's probably not a tremendous amount of upside left in the market unless if earnings surprise to the upside. Now that is the bull case. The bull case is that earnings are going to come in better, it's going to surprise to the upside, and that the PE ratio is actually in line with historical averages. But let's talk a little bit more about the bear case here. From an S&P 500 standpoint, if earnings come in below market expectations and we get to the $210 or $220 type of earnings here, it puts us at about a 4,400 S&P, which means that we're trading well above trend, and that could be a mean reversion coming. So what I want to talk through is the spikes that take place during recessions on PE ratios. And how this happens is the market front runs better expectations, and then all of a sudden earnings come in a lot less than anticipated, and we get a very high multiple on the S&P 500, which could actually be the setup for 2024. And I'm going to explain why that is. So markets right now are basically pricing in $250 to $245 worth of earnings, which gets us close to a 5,000 S&P. Basically a few percentage points away from hitting 5,000 on the S&P 500, which would put us, like I said, around that $250 a share worth of earnings on the S&P 500. But the question now becomes, what if earnings come in a lot light than anticipated? Well, if that ends up happening middle of the year, we're going to see the PE explode upwards because we've priced in so much forward earnings and companies are not hitting those earnings. That puts a higher multiple on the stock. And you basically can see those spikes take place. You get a market that's getting expensive, earnings don't show up, and then all of a sudden the multiple is exploding because the P of the equation is not following the E of the equation. And so you get that spike in valuations. And so things are very good now, but it's going to be the first quarter of next year to really let emotions settle and see where the true economy is heading. So now I want to talk about more of the bear case here. So let's start out with the most obvious signal, and that's going to be the inversion of the 3-month to 10-year treasury. That is still inverted, and the problem becomes when yields normalize, there's usually a clock ticking between 5 months to 12 months of when a recession normally hits. The problem with this indicator is there's no problems with the indicator. It's 100% accurate. Anytime the 3-month to 10-year has inverted and we get yields normalizing, we do have a recession following. But those yields haven't normalized yet, and so this market can keep going up, and it could be a year or two before we even head into a recession. So the timing of this is definitely not perfect. The next bear side of the case is, are we at peak employment? Meaning that employment's been so strong for so long and unemployment has been so low. Are we at a peak state of employment where actually it needs to cool off and we could go into a recession because employment is basically everything that's holding up this economy right now? So the bear case could be that employment is already peaked and that there's only one direction for employment to go. Now, the most obvious thing in the room that we've kind of been looking at and the whole market's been moving off of has been the Fed's move and inflation. Is inflation under control and are rates coming down? That's been the main move of this market, not really fundamentally driven on what earnings have been, but driven off of what the Feds are going to do and where inflation is, which has caused this market to definitely be a little expensive in my opinion. So the other thing we have to think about, is inflation even under control at this point? Or could we see inflation tick back up? We don't have an answer to inflation being under control. Target rate is going to be 2%. We're still nearly double that right now, which means there's a lot of work to still do, but the market doesn't really care if inflation's under control. They're already pricing it in being under control, and they're already pricing multiple rate cuts from the Feds, which is going to lead me to my next point. Multiple rate cuts are usually a bad sign. When the Fed has to come in and cut rates multiple times, means that there was an over-tightening in the economy and something broke, and the market's pricing in multiple rate cuts. The Fed is stating that there should only be a few rate cuts, about 2 to 3, but the market's pricing in closer to 6. And so with the stock market skyrocketing, but the dot plot now pushing 6 rate cuts, there's definitely a contrast here with this is either A, healthy inflation's under control, couple rate cuts, or B, the Feds have to do a tremendous amount of rate cuts because something broke in the system. The bond market is screaming something is broken. The dot plot's screaming something's broken. But the S&P 500 is going up and up and up. The next question is, have we even felt all the rate cuts that the Feds have put through the economy yet? And usually there's a 12 to 18 month window to where we really start feeling this monetary tightening taking place. And so I do think by the first and second quarter of next year, we're really going to feel how much tightening was put in the economy. And I don't think we've quite felt it just yet. We have to remember that banks did collapse not that long ago, where the Feds actually had to step in and tell people not to run on your deposits because everything was going to be fine. It wasn't that long ago that this took place. And is everything okay in the banking system? Everywhere we look, there's some sort of political tension taking place. And so when we think about COVID, this was a war on health. This was a war on a virus that caused many problems throughout the economy that was covered up with stimulus. But now there's physical wars going on in the world that any given time can disrupt just as many things as COVID disrupted. And so political tensions are rising. Inflation is still high, and the Feds are controlling policy. Those 3 signs are usually end of cycle, but we're getting a beginning cycle in the stock market, meaning that the companies that are rallying and the multiple expansion that's taking place is actually a beginning cycle expansion. But politics, inflation, and interest rates are telling us we're at the end of a cycle. So this is making it very, very confusing for individuals to understand if we are in the beginning of a cycle, the end of a cycle, are we heading into a recession, are we not heading into a recession? And so that's my bull bear case that I think about on a daily basis. And I want to share that with everybody because I don't want to be pessimistic on this channel. I really want to come in and be open-minded. And I believe what ended up taking place is the amount of stimulus that has been pumped through the economy, through government spending, the Fed stepping in, and student loan moratorium being pushed out even further, I think created a new bull market for a temporary period of time. Now, of course, I could be wrong, but I'm trying to make sense of this just like everybody else. And I think I do a pretty good job of really looking at the data points that I think are most accurate. But just want to be open with you on what my thought processes are going into next year. As always, I really appreciate everybody's time. Hopefully you enjoyed that, and we will see you in the next one.